right. So we're going to try to get a handle on how corporations really work, like from a financial perspective.
Yeah, absolutely.
We've got this lecture from Dr. B, and he goes through like everything
He covers a lot.
from, the basics of stock
Yeah.
all the way up to like treasury stock and stuff.
It's a lot, but I think we can
Yeah.
break it down.
I don't make it understandable.
Where does a corporation even begin? How does it even get started? Dr. B used this interesting story about a student of his named Norin to illustrate it.
Right. And so Norin, I think what's interesting there is how they determine ownership right from the beginning.
Right.
Norin brings some equipment, a vehicle, and some cash to the business, and Dr. B contributes a larger sum of money.
Okay.
And so how do you figure out who owns how much of the company?
Right, yeah.
And so they basically take stock of everything, figure out the total value of everything.
So it's not just about who puts in the most money.
Exactly.
Okay. It's about the value that each person brings.
Got it.
And from that determines the percentage of ownership.
Okay, so then what about Dr. B also talked about private versus public companies.
Right.
What's the difference there? Does that affect how the ownership works?
It doesn't change the ownership structure itself.
Okay.
But it impacts who can buy and sell that ownership.
Okay.
Think about a privately held company. It's kind of like a family business.
Okay.
They're held by a select group of people, and they're not traded on the stock market.
Yeah.
Whereas publicly traded companies, right, anyone can buy their shares.
Okay, got it.
You see them on the stock exchanges,
Okay, so it's just about access.
Yeah.
All right.
It's about who has access to buy and sell those shares.
Got it. Okay.
Yeah.
Now, he also mentioned some benefits and drawbacks of these corporations.
Right.
What stood out to you there?
Well, I think one of the biggest advantages is limited liability. The corporation becomes its own legal entity separate from the owner. So if the company gets sued or goes into debt, the personal assets of the owners are protected.
Yeah, that's huge.
Exactly.
So you're not putting your house on the line
Exactly.
if you start a corporation.
Yeah.
And then there's this continuous life thing he was talking about.
Right. Corporations can theoretically exist forever, unlike a partnership, which might dissolve if one partner leaves, right?
Right.
You can easily transfer ownership, but the corporation just keeps going.
That's interesting because it kind of makes you think of those big companies that have been around for decades, you know?
Yeah.
Like they're almost like living entities.
That's a great way to put it, in a way.
Yeah.
Of course, there are some downsides, like more regulations from the government and maybe more complex taxes.
Sure, there's always a trade-off, right?
Yeah, absolutely.
So the corporations offer a lot of advantages, but they come with more rules and potential complications.
Exactly.
Right.
It really highlights the different business structures and how important it is to think through those carefully when you're choosing one.
Absolutely.
Yeah.
Now, Dr. B said something that I found really interesting, and it seems a little counterintuitive.
Yeah.
He was talking about how corporations are actually quite democratic.
Right.
Can you explain that a bit more? It just seems odd with all this talk about CEOs and boards of directors that they're democratic.
Well, the shareholders are at the top.
Okay.
It's the shareholders who elect the board of directors, and then the board of directors oversees the management of the company.
So the shareholders are like the voters, and the board is like the...
That's a great way to visualize it.
Government,
Absolutely.
making sure things are running smoothly.
Yeah. And shareholders have rights.
Okay.
They can buy, sell, or get rid of their stock. They can buy more shares if they want.
Nice.
And they can even receive a portion of the profits if the company pays dividends.
Dividends.
Yeah.
That sounds like a nice perk.
It can be, but it's not guaranteed.
Okay.
Not all companies pay dividends.
Yeah.
And it really depends on the company's situation, and their strategy.
Right.
The board has to decide if they're going to pay dividends, reinvest in the company, all sorts of different things.
So there's a lot more to it than just handing out cash to the shareholders.
Yeah.
Okay.
Yeah.
Now, Dr. B brought up some terms that I found kind of tricky.
Okay.
Like authorized stock, par value.
Okay, sure.
Market price.
So authorized stock, let's start there.
Okay.
Think of authorized stock as setting a limit. Okay.
Okay.
When a company is formed, they decide on a maximum number of shares they can issue,
Okay.
and that's the authorized stock.
Got it.
They don't have to issue all of it right away,
Yeah.
but they can't go over that limit.
So it's just a limit
It's about to maximum.
Got it.
Yeah, and then par value.
Now, is par value the, actual price of the stock?
No, not quite.
Fine.
Par value is like this minimum value assigned to each share when it's authorized.
Yeah.
It's often like a tiny amount, like a penny or something.
Yeah.
And it doesn't really reflect the actual market value.
Okay, so the market price is what people are actually paying for on the stocks.
Exactly. That's the real-time value.
Got it.
It's constantly fluctuating.
Yeah.
Based on supply and demand, the economy, all these other things.
Okay, so par value is just a technicality.
Yeah, it's a technicality.
Market price is the real deal.
Yeah. And there's also non-par value stock, where there's no par value assigned.
Okay.
That's often used for things like employee benefits.
Okay, that makes sense.
Yeah.
Now, he also talked about stockholders' equity.
Yes.
What exactly falls under that umbrella?
So stockholders' equity represents the owner's stake in the company. It has two parts: paid-in capital, which is the money the owners have directly invested in the company. And then you have retained earnings, which is the cumulative profit the company has kept over time.
So paid-in capital is like their initial investment.
Right, exactly.
And retained earnings is kind of like the company's savings account, built up.
Yeah, that's a great way to put it.
From its profits over time.
It helps you understand where the company's value comes from.
This is really interesting.
Yeah.
I'm starting to get a clearer picture of how it all works.
And you'll see how these terms, even though they sound technical, help you understand the bigger picture.
Absolutely.
Yeah.
Okay, so we've talked about how corporations are formed, the basics of stock.
Yeah.
Now, what happens when a company actually decides to issue stock?
Well, let's look at Dr. B's example of the snowboard company.
Okay.
They decide to issue 30,000 shares of common stock at $10 par value.
Okay.
And that brings in $300,000.
So what do they do with that $300,000?
Well, that money goes into the company's coffers.
Right.
You know, they can use it for operations, invest it in growth, maybe pay off debt.
Makes sense.
They've basically exchanged ownership for capital.
Okay. And then he mentioned something about issuing stock at a premium.
Right. So selling at a premium means issuing the stock at a price higher than par value.
Okay.
So let's say the snowboard company sold their stock for $12 per share.
Okay.
Instead of the $10 par value.
Okay.
That extra $2 is the premium.
So why do they do that?
It shows that investors believe the stock is worth more than its basic par value.
Got it.
They're willing to pay a premium for a piece of the action.
Okay, so it's not just about the numbers.
Right.
It's about, investor perception.
Absolutely.
Confidence in the company.
Yeah, it's all about perception.
Now, how do they record that premium?
They use a separate account called paid-in capital in excess of par value.
Oh, so it's not just lumped in with the common stock.
It's about transparency. So investors and analysts can see how much money they raised beyond the basic value of the stock.
It's a more detailed breakdown, basically.
Exactly.
Now, remember we talked about non-par value stock?
Yeah.
You know, like in Dr. B's example with his lawyer.
Right.
He used non-par value stock.
It can simplify things.
Okay.
You know, if they issue the 1,000 shares for $40 a share, they record a $40,000 increase in cash.
Okay.
And a $40,000 increase in common stock.
So it's much more straightforward.
Yeah, exactly.
When there's no par value.
Right.
Now, Dr. B also had this interesting scenario with Coca-Cola acquiring land.
Right. They didn't even use cash.
Yeah.
You used stock.
Yeah. How does that even work?
Well, it's all about fair value.
Okay.
So let's say the land was worth $100,000 and Coca-Cola issued 4,000 shares at $20 par value.
Okay.
Well, the par value of that stock would only be $80,000, right? 4,000 times 20.
Yeah.
So to account for that extra $20,000, they use that paid-in capital in excess of par value.
So it's like they're saying, hey, this land's worth more than the basic value of our stock.
Exactly.
So we're reflecting that in our accounting.
Yeah.
Wow. This is a lot to take in.
It is, but I think you're doing great.
I'm starting to see how all these pieces fit together.
It is like a puzzle.
Yeah.
Once you get all the pieces,
absolutely,
the bigger picture emerges.
So I feel we've covered a lot of ground already, from the basics of corporations to how they issue stock and stuff.
Yeah. What do you think? Where should we go from here?
Well, we talked about how they raise capital through stock, but what do they actually do with that money? And how do they, reward their investors? Should we talk about dividends?
Let's dive into dividends.
All right, let's do it. Okay, dividends. It seems like everyone wants a piece of that pie.
Right.
But Dr. B made it clear that it's not as simple as just like handing out cash.
It's not simple at all.
So like, what's the strategy there?
Well, you can't give away what you don't have.
Right.
So the company has to have enough retained earnings, enough cash flow to support paying dividends.
So it's not just about being generous with the shareholders.
No, it's definitely a financial balancing act.
Yeah.
Yeah, they have to think about things like reinvesting those profits back into the business for growth, or saving up for an acquisition, or maybe even paying down debt.
So it's like deciding between spending your money now or saving it for something big later.
Exactly.
Okay.
And when a company does decide to pay dividends, there's a process marked by 3 important dates: the date of declaration, the date of record, and the day of payment.
Okay, so let's go through those.
Yeah.
What happens on the date of declaration?
That's when the board of directors announces the dividend.
Okay.
They state the amount, they state the payment date.
Okay.
And this is really important.
Yeah.
It creates a liability for the company.
So it's an actual promise.
It's a promise.
To pay. Okay.
And they record that by decreasing their retained earnings and increasing a dividends payable account.
So they're acknowledging they owe this money to the shareholders.
Exactly.
Okay, what about the date of record? Is that when they actually, like, cut the checks?
No, not quite.
Okay.
The date of record determines which shareholders are eligible to receive the dividend.
So it's just a marker.
Yeah, it's like a snapshot in time.
Got it.
No actual journal entry is required on this date.
Okay, so if you buy the stock after that date, you're not eligible.
You miss out on that dividend.
Okay.
So you got to be mindful of those dates.
All right, then we get to the date of payment.
That's the exciting part.
I was going to say, that's the day everyone's waiting for.
Right, that's when the cash actually changes hands.
Okay.
The company fulfills its promise by distributing the dividend to its shareholders.
Okay.
They reduce their dividends payable and decrease their cash account.
So it's like closing the loop on that initial promise.
Exactly.
Now, what about these stock dividends?
Okay, so stock dividends, instead of giving out cash, the company distributes additional shares of stock.
Oh, so they get more stock.
Yeah.
But the company doesn't give up any cash.
Exactly.
So why would they choose to do that?
Well, it helps conserve cash.
Right.
Right. So they can reward those shareholders, but still have that cash on hand.
Makes sense.
Right, to invest in new projects, expand the business.
Okay, but doesn't issuing more shares dilute the value of existing shares?
That's a great question.
Yeah.
And it depends on the size of the stock dividend.
Okay.
So we have small stock dividends. Those are less than 25% of the outstanding shares.
Okay.
Those typically don't have a significant impact on the price.
Okay.
But larger stock dividends, those can potentially dilute the value.
Yeah, I was thinking about that, like cutting the pie into more slices.
Right, exactly.
So each slice is smaller, but everyone gets more.
Right, that's a great way to visualize it.
Okay.
Now, the accounting for stock dividends, whether they're small or large, is a little more nuanced, but they're essentially shifting value from retained earnings to common stock.
Okay.
Yeah.
Now, I also remember Dr. B talking about stock splits.
Stock splits?
Yeah.
Yeah, he used his own Starbucks stock as an example.
Yeah, and he made it sound so simple, like cutting a pizza in half.
Yeah, yeah.
But, like, what's the purpose behind a stock split?
It's about making the stock more accessible to a wider range of investors.
Get it.
So when a company splits its stock, the price per share is reduced.
Okay.
You still have the same overall value, but now it's just more affordable.
So if a company's stock is really high, it might scare some people away.
It can be intimidating.
Yeah.
For sure.
So a stock split kind of
makes it more approachable.
Yeah. So with a stock split, there's no
journal entry required. It just changes the number of shares.
And the par value per share.
It's like changing the packaging without changing the product.
I like that. Yeah.
Now, so far we've been talking a lot about common stock.
Yes.
But Dr. B mentioned this other type of stock, preferred stock.
Preferred stock.
Yeah.
So preferred stockholders, they have certain advantages over common stockholders.
What are the advantages?
They typically receive dividends before common stockholders.
So they get paid first.
They do, and if the company liquidates, they also have a higher claim on the assets.
So it's like having a first-class ticket on the corporate train.
Yeah, I like that analogy.
But why would a company choose to issue preferred stock in the first place?
Well, it can be a strategic way to raise capital without diluting the control of existing common shareholders.
Okay.
Because preferred stockholders usually don't have voting rights.
Oh, interesting.
Yeah, so they can attract investors without giving up control.
So it's a way to get the funding, but not rock the boat.
Right, exactly.
Oh.
Too much.
Yeah.
Okay.
And it appeals to certain investors who are maybe looking for a more stable investment with predictable dividend payments.
So they're okay with giving up the voting rights for the security.
They are.
Okay, and then you said there's, within preferred stock,
Yes.
another layer of complexity.
There is. Cumulative versus non-cumulative preferred stock.
Okay, so what's the difference between those two?
The key difference is what happens if a company skips a dividend payment.
Okay.
With cumulative preferred stock, those missed payments accumulate, and the company has to pay them.
So it's like a rain check.
For those dividends.
Guaranteed to get it eventually.
Exactly. So it's a little safer for investors.
Yeah.
But cumulative preferred stock usually trades at a premium.
Because it's safer.
Because of that added protection.
Risk and reward.
Exactly.
Now, we've talked a lot about companies issuing stock, but what about the opposite? Can they ever take stock back?
That's a great question, and it leads us to treasury stock.
Treasury stock. That sounds kind of mysterious.
It's a company's own stock that it has repurchased from the market.
Oh, okay.
So the company is buying a piece of itself back.
So why would a company want to do that?
It can be strategic.
Okay.
One reason is to reduce the number of shares that are outstanding.
Okay.
And by reducing those shares, that can boost earnings per share.
Because the same profits divided by fewer shares.
Exactly. So it's like shrinking the pie to make those slices bigger.
I got it.
Yeah. They might also use treasury stock for employee stock option plans.
Okay.
Or to defend against like a hostile takeover attempt.
Wait, a hostile takeover? What is that?
It's basically when another company tries to acquire a company against the wishes of management.
So it's like a defense mechanism.
Exactly. They're protecting themselves.
Wow.
And to wrap up, Dr. B talked about financial ratios.
Okay, so ratios. I love ratios.
Yeah, they're like tools that help investors and analysts understand a company's health and its performance.
Okay, so which ratios did he focus on?
Well, we've already talked about earnings per share.
Right, EPS.
Right, but he also talked about price-earnings ratio and dividend yield.
Okay, so what's the PE ratio, the price-earnings ratio?
Yeah, that compares the company's stock price to its earnings per share.
Got it.
So it tells you how much investors are willing to pay for each dollar of earnings.
So a higher PE ratio means people are like more optimistic.
They're optimistic about future growth.
They think it's going to be worth more later.
Exactly. And then finally, dividend yield.
What is that?
That measures the annual dividend payment as a percentage of the stock price.
Oh.
So it tells you how much cash you can expect from those dividends.
Okay, so it's about return on investment.
It is, especially for those investors who are looking for a steady income stream.
Wow, this has been a lot.
It has.
My head is spinning.
I know, it's a lot to take in.
But I feel like I'm starting to see things differently.
I think you're doing great.
Like with a whole new lens.
Yeah, and that's what it's all about. Expanding your knowledge.
Yeah.
So you can make more informed decisions.
Absolutely. We've really gone deep on corporate finance.
We have. It's been quite a journey.
Learned a lot.
Yeah.
But, I was thinking Dr. B's lecture, it was really focused on the numbers.
It was.
Like, he didn't really talk about ethics at all, like social responsibility or sustainability.
Yeah, that's true. Traditional financial analysis often focuses on things like profits and earnings and shareholder value.
Right, like the bottom line.
Exactly.
But there's this whole movement now, like ESG, environmental, social, and governance factors.
Absolutely. It's becoming increasingly important.
Yeah. It seems like everyone's talking about it.
Yeah, investors and consumers are paying more attention to a company's impact on the world.
Right, it's not just about making money anymore. It's about making money responsibly.
Exactly, and many companies are realizing that incorporating ESG factors into their decisions can actually be good for business.
How so?
Well, for one, it can help attract and retain talent. People want to work for companies that are doing good in the world.
Right. Makes sense.
Companies with strong ESG practices also tend to have a better reputation.
Yeah.
Which can lead to more customer loyalty and brand value.
So it's not necessarily a trade-off between doing good and doing well.
Not at all. Studies have actually shown that companies with strong ESG performance often do better financially over the long term.
That's interesting.
Yeah, it's a win-win.
So it seems like it's more important than ever for companies to think about the bigger picture.
It is. They need to consider their role in society.
Absolutely.
So as you learn more about companies and investing, I encourage you to look at their ESG practices.
Yeah, I will.
Do they have a sustainability plan? How do they treat their employees, their supply chain?
Yeah, those are all really important things to think about.
They are.
Well, this has been fascinating.
It has. It's been a pleasure diving deep into corporate finance with you.
I feel so much more knowledgeable now.
That's great to hear.
Thanks for guiding me through it.
Anytime. Happy investing.